Let me delete this. In our last class, we talked about market structure. We talked about three types of liquidity. I introduced you guys to three types of liquidity. We talked about the trade line liquidity, inducement liquidity, and um, general liquidity. Based on those three liquidities that we talked about, those liquidity are responsible for where to take our entries, or how to take our entries and how to set our TF and SF. And then we talked about two types of what concepts, the concept of reversal and then the concept of continuation. We talked about the concept of reversal. We catch market what when we have a market structure shift. To catch a reversal, we need to have a market structure shift. A market structure shift happened when market broke the last low that caused a break of structure to the downsides, this order block. When market broke above this one, that's when we have a market structure shift. When market tapped into a demand zone, daily or hourly demand zone. This is when we get a reversal concept. This is how we use the concept of reversal to catch a trade like that. And then I talked about the concept of continuation. For concept of continuation is when we have a break of structure to the current direction of the markets. For markets to maintain bullish or bearish structure, it must be breaking up to the upside. We talked about all of this, right? Can you guys hear me?
Yes. Yes.
So in this class, we're going to talk about how we can take our entries based on what I teach you yesterday on our last class. Said if we have a market structure shift, there are possible 2 points of interest we can use. When market break a structure, we have one. When we break this structure, we break this high, then we break this high. That means we have how many points of interest in our position? We have 3 points of interest. We have the order block that posts all of this break of structure. We have this breaker block, and then this breaker block, and also this breaker block. For us to catch this continuation, we have how many points of interest in our position? We have 4 points of interest we can use to take this trade. All of those 4 points of interest, we can use them when they meet one of the 4 of these criteria that I'm about to teach you in this class. So in this class, we are going to talk about 4 methods, or I say 4 guidelines I use when choosing a point of interest. I explained what a breaker block is, and I explained that it's one of the point of interest we can use to take either continuation or reversal. So based on those 2 things, there are 4 guidelines, or I say 4 rules that we must follow to take any trades, either continuation or a reversal. Can you guys hear me?
Yes.
Yes. I can hear you, but your voice is kind of low.
My voice is what?
It's not that high, it's low.
Right, sorry. Can you hear me now?
Yeah, I can hear you.
Okay. I say there's 4 methods that is going to help us to determine which one of the point of interest we can use. If we have a break of structure to the upside, we have different point of interest. Market break multiple structures, break this high, then break this high. So we have 1, 2, 3 point of interest we can use. So which one can you choose now? This is why this method is going to help you pinpoint and narrow down which one of the point of interest you can use. And I'm going to explain those 4 methods, and I'm going to show you inside the chart. So you have to be very careful about this class, because after this class, I'm going to give you guys assignments, and that assignment is compulsory assignment actually. So there are 4 methods. You can call them rules or guidelines I use when picking up a point of interest. The first one says there must be a market structure shift or break of structure, or in other case double break of structure. I explain what market structure shift is. So for you to take a buy or a sell in a market, there must be a market structure shift. A market structure shift is what? When market invalidates the last lower high. When we have a what? Downtrend, when market invalidates the what? The last lower high after it tapped into a what? Demand area, which we want to talk about when we come to directional bias. If we have a demand zone that we want to buy a market from, a market was selling down toward that demand zone, we're only going to consider a market structure shift when market tapped into this demand zone. If we have a market structure shift along what the current what location of the market, if market did not tap into that zone, let's say for now, when market was selling, we got a break on what? A market structure shift right here. Market take out this high. This is not a market structure shift. There's a lot of mistake people used to make. When you have a market structure shift that is not coming from anywhere, the first thing you should consider when you're looking for a market structure shift is this zone, the zone that caused the market structure shift. Is it a higher time frame key level? Is it a strong order block or breaker block? It does not matter the bias. You need to know where this market structure shift is coming. Sometimes market might do this just to take out liquidity and what? And tapped into a what? Nearest supply zone for markets to continue pushing down. So the first rule, what? You need to know where this market structure shift is coming from. If it's not coming from a key level, it's not coming from an order block or breaker block, this is not a market structure shift. It's just what? Market breaking internal structure for what? The sales to continue, to grab some liquidity for sales to continue. You need to keep this in mind. That's why when we come to directional bias, and we're going to explain how you can use your internal structure and external structure in your advantage to take a high probability setup. So any market structure shift that did not happen inside this our current zone, this demand zone or supply zone, don't consider it as a market structure shift. So our first rule says there must be a market structure shift. For us to confirm a market structure shift, it must come from a what? Our demand zone, a higher time frame demand zone. When market tapped into this zone, so this is where we expect what? Markets to cause a break of structure to create a what? A market structure shift. If this market structure shift is not coming from a order block or breaker block, this we don't consider it as a what? A valid market structure shift. So the first rule says there must be a market structure shift or what? Breakup structure or double breakup structure. This is double breakup structure. You can easily say a what? Multiple breakup structure. As I give you example on this one now. On this one, I said when we tapped into a high time frame key level, market broke two structures, this high and then this high. That is called a multiple breakup structure. Or when market is what? When market is what? Counter trending. When you have a what? Market started what's buying. When we have a what? Market structure shift, and then market tapped in and started selling. So when market started selling, we know that what currently we only going to what? Catch continuation of this sell. So when market broke structure to the downsides, then you go into what? Sorry. Then you look back, you look inside your chart to see what, where do you have different breakup structure. As you can see, this market break this structure and then break another low here. So this is called double breakup structure or what? Multiple breakup structure. It might break different structure as market was selling down. So do you understand what I meant by multiple breakup structure?
Yeah.
Right. So this is how you consider a multiple breakup structure or what? A market structure shift. So first rule says there must be a market structure shift. You can call it rules or what? Guidelines. And then the second one says there must be a liquidity. There must be a liquidity. or inducement liquidity. Inducement is one of the types or three types of liquidity I introduced to you guys because it's very common to see. That's why I use it differently than other liquidity. Sometimes when market taps into your higher time frame key level, we create most of the time market give you an inducement liquidity instead of what engineered liquidity or trend line liquidity. We're going to explain all of those types of liquidity, but you need to understand when you have a market structure shift, the second guideline, the second rules you must follow is what? You must have a liquidity protecting your zones. A liquidity, I talked about what a inducement liquidity is. I said inducement liquidity is the first pullback when market break a structure. When market break a structure to the upside or what downside, the first retracement market make after break a structure, immediately after the break of structure, is called an inducement. So there must be an inducement or what liquidity. Market might give you an what trend line liquidity. When you have trend line liquidity, you must wait for your what a market structure shift. This is what I just explained. When market was approaching any of your point of interest, when you have a break of structure now, we can clearly see we have 2 point of interest we can use. We have this breakout block. Then we have this other block.
I'm not gonna come on time.
We have this breaker block and this other block. We have 2 points of interest we can use to what? Catch this market forward reversal. We have 2 points of interest. The breaker block and then the other block. These are the 2 points of interest we can use to what? Catch continuation of this buy. So that says there must be liquidity. So inside these zones, there are 2 types of liquidity I explained to you guys clearly. I said there will what? There's inducement liquidity, the first pullback after we got a break of structure. And then there's what? Trend line liquidity. Market creating trend line liquidity as what? Is approaching this your zone. When you have this trend line liquidity, a market tapped into your zone, you will have to wait for what? Market structure shift. That's what I just explained. So even if you have a break of structure, market give you somewhat series of trend line liquidity as it's approaching your zone. You have to first wait for market to tap into that your zone. Then you look for another market structure shift for you to what? Take your buy from there. But when market give you an inducement liquidity, we said inducement liquidity is the first pullback when we have a break of structure to the upside or to the downside. That's the second rule. There must be a liquidity. Then the third rule says the POI, which is our point of interest, must not be mitigated. I'm going to explain this. The point of interest, we have 2 points of interest, the breaker block and then the other block. So this rule says the point of interest we're going to use must not be mitigated, must not be touched when market is what? Creating the inducement. When market break a structure, market retrace back and touch this zone before pushing up to the upside. This zone is what? Mitigated, has been touched. That's what I mean is mitigated. So the point of interest must not be mitigated. Sorry. Must not be mitigated. That means your point of interest to choose from must not be what? Mitigated. When market give you an inducement liquidity, this inducement liquidity must not touch any of this zone. If your inducement touch any of this zone is automatically invalid. You're not going to use it. The zone is automatically invalid. You're not going to use it. That's the third rules. So when market give you inducement and this inducement did not touch any of your breaker block or other block, so that means these 2 of your zones are what? Are qualified. You can use all of them. Then you use what? The 4th rules. And that the 4th rule says, choose your point of interest that is what? That is closest to the inducement. The fourth guideline says you should choose your point of interest. The point of interest is a breaker block or order block. When we have an inducement liquidity, and that inducement liquidity did not mitigate any of these two zones, that means we have two zones we can choose from. So the fourth rule says you should choose your point of interest that is closest to the inducement, that is close to the inducement, which is what? Which one is the closest, the breaker block or the order block? Is the breaker block. So that means your point of interest, the zone you're going to choose for what? This continuation will be from the what? Breaker block. I explained this. I'm going to recap and explain this again in a short time so that I'm going to show you inside the chart. I said the first rule says there must be a market structure shift or what? Or breakup structure or multiple breakup structure. Anyone can do. Either market structure shift or breakup structure or double breakup structure. Then there must be a liquidity. Liquidity can be trade line liquidity or what? Inducement liquidity. Third rule says the point of interest must not be mitigated. Then you have to check these two zones that market just broke. When market creating the inducement, you may have to make sure market did not tap any of them. If market tapped either your breaker block or your order block, that zone is automatically disqualified. You're not going to use it as your what? Point of interest. Then the fourth rule says choose your point of interest that closest to inducement. So that means the one that is close to the liquidity, this breaker block. So when market tapped into this zone, let's say when market creates this inducement, it tapped into this breaker block. So we know that this breaker block is automatically invalid. We're not going to use it to take our buy. We're going to use the other point of interest, which is what? The order block. In this scenario, if we have something like that, in this case, we have triple multiple breakup structure. Market tapped only this zone and then push up, give us that inducement liquidity. So we know that this first breaker block is invalid. We have two other point of interest we can use. Then we're going to choose the one that is closest to the inducement, which is what? This second breaker block, and not the what? The order block. And not the order block. So I'm going to show you this inside the chart, and I'm going to show you an example where we use the order block, and I'm going to show you the example where I used what? The breaker block. I think I've taken trades just today, this US30. I take these trades today using the same thing. But let me show you based on the currencies I mostly trade, which is BTC, and you see I'm currently in this trade. Also the same thing, breaker block, inducement, then point of interest closest to inducement. But let me show you let me go to, this is BTC. So the first thing we're going to do is look for where market is reacting to. To know that, you have to go to higher time frame to see market at the what? Higher time frame to see your bias. So if you go to 1 day time frame, let me use the forex.com. All right. So if you go to higher time frame, you see clearly market is selling down, giving you what? A series of what? Lower low, lower highs, lower low, lower highs, lower low, lower highs, lower low, and then we consider this to be what? A lower high before what? For markets to continue selling down, it must what? Break this last low, because the overall is what? Bearish. So for market to continue selling down, this is the target of markets, right? So unless we're going to have a market structure shift in higher time frame, when market break this high, which we want to talk about when we come to what? Using internal structure and then external structure. The first thing to look is what? Where market is reacting to. So if you look aside, you know that markets just tapped into this order block right here, this demand zone. This is all what you want to see in what? Higher time frame. Market tapped into what? This demand zone. When you see market tapped into a demand zone, we know what we're looking for, right? Because we have a massive sell currently from here, this impulsive move. So we expect this to be a correction move on BTC, USD. So this impulsive move come and tapped into this demand zone. So we expect a what? A correction move, which is what? our what? Our correction move. So we know that we're going to have a what? We need to have a market structure shift because it's a change of trend. This was a what? Bearish impulsive. So we're going to have a what? Bullish correction. So when market tapped into this, our order block, this demand zone, this is what we want to see in higher time frame. The second thing is what? To look for these four rules that I talked to you about. The first one is either market structure shift or what? Break of structure. So if we go to lower time frame, at that zone that market tapped into, we go to lower time frame. This is the zone. Let me clean this. So we're going to read the structure and see or what? Either we have a market structure shift or what? A break of structure. If we read this structure, this is a what? Beginner friendly market structure. Market is giving us what? A series of what? Lower low, lower highs, lower low, lower highs, lower low, lower high, lower low, lower high, lower low, lower high. Sorry. Then we have a what? A lower low right here. We have another lower high. Then market give us a what? A lower low. Just look at this. This is the our low that caused this break of structure. This is our what? Lower low. Then we have a what? This is our lower high. This is our lower low. So instead of markets to create another market give us this is lower low, lower high, this is lower low. Instead of market to create another lower high and continue pushing down, market come back and take out this recent high, this lower high. That's when we have a what? A market structure shift. This is called market structure shift. Market taking out this lower high. And you see this, the buy is coming from a key level that caused this market structure shift. So this is what? We check one, we have a market structure shift. Then we go to the second rule that says what? There must be a what? Liquidity. So if you check clearly, we said what is inducement liquidity? Is the first pullback market make when we break a structure. So you see, this is where we get a what? An MSS, market structure shift. So after market break above this one, it retraces back inside, which is what? This is our what? Inducement liquidity. This is inducement liquidity. So the third rule says what? Our point of, how many point of interest do we have? We have this breaker block, the market just break above. We have this breaker block, and then we have this other block sitting right here. These are the 2 points of interest we have in the market. But the third rule says what? Our point of interest must not be mitigated. So when market is creating that inducement, it should not touch any of these zones. It should not touch any of these zones. So you see, when market creating inducement, it tapped into a breaker block. So this breaker block is automatically invalid. We're going to remove that in our what? In our calculations. Automatically, this breaker block is invalid because market tapped into it when market is what? Creating our what? Inducement liquidity. So this is automatically invalid. Then the fourth rule says what? We should choose our point of interest that is closest to the inducements, which is what? This is the only other point of interest we have, the other block, and it's close to our inducements. So anytime market returns to this zone, this is where we expect our what? Our continuation of the what? Of buy. So let's zoom out. So market come and tapped into that zone, you see? Market come and tapped into that zone right here. So this is where we take our what? Long position. From there, our stop loss below our order block. Then our take profits this is a topic of its own. How do we use internal and external liquidity to what? Set our TP and SL. But in this case, I'm going to just going to summarize things for you. I'm not going to, this should be a topic of its own. But what our point or what our target should be either trend line liquidity or what any recent high or internal structure. So if I target this trend line liquidity, this high, so you see this is, you can refine your what your point of interest in lower time frame. So you see, I just targeted this side. This is 1 to 5 R, and this is how you can use what a market structure sheet to catch a reversal using these 4 rules that I just mentioned. You see, it's making things easier for you guys. So this is one. So this other one I explained is what? Taking a trade using a breaker block, which is what? A continuation. So let me use the current price actions so that you'll not be confusing if I use the other price actions. So what do we expect to see when we want to take a continuation? If you see clearly right here, market is what? Clearly bearish, it's selling. I'm trying to explain this using the current price action so that you won't be confused. So you see market is what? Clearly bearish, making what? Lower low, lower high, lower low, a lower high. Now market again creates lower low. So with that, you can use that as your advantage to know what you're looking for, what? A break of structure. So if you come here, right here, you see this is an order block, right? It's an order block that causes a break of structure to this upside. It breaks this high. So this is clearly an order block. This is clearly an order block. So anytime market return to this zone, you expect a what? A market to what? To buy. So but you see when market come back, it just started buying and then invalidate this zone. So this, then you should be looking for, when you have what? This invalidated order block, then you should be looking for what? For sell. But this is not high probability order block because what? Market tapped into it before started buying. So this is not an order block. An order block, I said, it should not be mitigated. So for me to what? To determine an order block when it causes a break of structure to the upside. So that zone, this order block that I marked, when market do something like this, market come back and tapped in the order block. So when market disrespect this order block, I will not consider it a clear breaker block, because already market come and tapped into the order block and buy again. This is what happened here. Market come and tapped into the order block and buy again. So it's a breaker block. You can just call it a resistance area, but this is what? A weak breaker block, because it's a mitigated order block. You have to go and rewatch this video. I explain what I meant. We have this order block. Market come back and tapped into the order block before buying. So anytime market invalidate this zone is a weak already, because market was tapped into the zone like this. So for me to consider this one as a what? Great for good breaker block, market should not come and tap into the zone and started buying. It should just come and break above it, below it. So this is a clear breaker block. Anytime market return to the zone, I know it did not use it as a breaker block, as an order block. So when market come to that zone, it will use it as a breaker block. So this is how you can choose a perfect breaker block. I think I did that in our last class. So you see market tapped into that zone. It did not say like this is a mitigated order block. So is there low probability for markets to come and tap into that zone? Then you look for another breaker block. You can trade that one if you have a clear inducement. As you can see, there is a clear inducement and market did not tap it and started selling. So if you look below right here again, there's an order block right here. The market disrespects. Market disrespect this order block. So if you go to lower time frame, this is the order block. You see, market did not tap to the order block. It just come and invalidate this order block. So this is a good breaker block to use because market just invalidate it. So how many break of structure can you see? Market break this low, this current low of the what? Of the order block, which is 1. And then market break another low, this low, which is 2. You have multiple break of structure. I'm sure if you look inside, if you look at the other label, this zone, market break this low, can you see? Market also break this level, this low. That means you have how many break? 3 triple break of structure. So 1 is okay, 2 is okay. It's just that you have to have a break of structure for our rules. Then the second rules is what? We need to have an inducement liquidity or what? Trailer liquidity. What is inducement liquidity? Is the first pullback when we have a what? Break of structure. So after this market break this structure to the downside, this is the first pullback market makes. This bullish candle, can you see? This is our first pullback. We have a break of structure. We have a break of structure. Then market come back and fall inside the zone, then started selling again. So this is our inducements. So then we have 2 points of interest. We can take this sell continuation. We have this order block, which is 3 candle formation order block. We're going to talk about deep when we go to the next class, but this is not, I don't consider this an order block, but some people do. So this is a order block. This is an order block that caused all of this break of structure. And then this is our breaker block. Then our third rule says what? All of our point of interest must not be mitigated. So you know the breaker block has not been mitigated. Same thing with the order block. None of them has been mitigated. Then the third rule says, the fourth rule, we should choose our what? Point of interest that is closest to inducement. You see this one, this breaker block is the closest to the inducement. That's why market tapped into this breaker block and started continuous selling from that zone. And for markets to continue selling, we know the target of this market is what? This low. Because for markets to continue selling down, it's targeting low, lower low, lower high. So that lower high, which is this one that just tapped into our zone, is going to cause forward a break of structure to this to take out this low. You can use that low, this low, because this low just took out this low. So when you want to place your take profits, you know that for market to continue selling down, it must take out this low, this low. So it should be your first target. It should be your first target. So you see, this is how you take the trade using continuation. This is 1 to 10R, almost 1 to 11R. This is 1 to 11R. Using the same concept, you see it what? It minimizes all of this work for you. These 4 rules, you see, it minimizes all of this work for you to just take a trade from here. To just take a trade from anywhere. When you apply all of those 4 rules, you can clearly see market just tap into this breaker block and not the other block and just continue selling down. So this is what you're going to do. Let me show you. Let me change the fair and see if I can find another one. This one is the same thing that I did. When I go to 4 hour, I use the internet structure, which we want to talk about when we go to our advanced session. This is all like I would say it's like fund of advanced, but this is like a basic for me actually. This is basic, so you need to be understanding things. So you see, this is 4 hour order block. Market tapped into the 4 hour order block, right? So when you go to the 30-minute time frame, you look for that your what? So clearly, when you see this, when market was coming to this order block, it's what? Creating series of what? Lower low, lower high. And then lower low, lower high. Then you have another lower low that just take out this high. So you see this high now. Let me try again so that everyone can understand. Lower low, lower high, lower low, lower high, lower low, equal high. You see, we have a market structure shift inside this, but it's not coming from a key level, so we not consider it. So we have another lower low, lower high, then lower low, then lower high, then we have lower low. We tapped into that 4-hour key level. Then market just come and take out this high to give us a what? A market structure shift. This is where we get our what? A market structure shift. This low that market just take out. Market just take out this one to give us a what? MSS, a market structure shift. What is our inducement? The first pullback after we get a market structure shift, which is what? This low right here. This is our what? Inducement. Where is our point of interest? This is the only point of interest we have. This order block. We have the breaker block, but market tapped into the breaker block. It what? Mitigate the order block. So we're not going to use the breaker block because market tapped into that breaker block. So this is what? The only point of interest we have. So we can place our buy from there, from the order block. Our stop loss above this, below this low. Then our take profits, we can target any draw liquidity. Where can we see? We can target this high. So I take these trades. We check my TikTok. I take these trades today. So this is how I caught these trades. And I have another one on. I'm just showing you on current price action so that you not be confusing. It's not like you see something different. You say, okay, in back then market was not like that, but blah blah. That's why I'm showing you in current price action. I can show you in what last 2 months or last 3 months. You can see them clearly anywhere you can see them. You just have to wait for market to tap into a demand zone. The same thing I took this silver. It's the same. It's the same. Boss, I have a question there. Okay, unmute yourself. Ask the question. Unmute yourself. I allow you. Unmute yourself. Ask the question.
Good evening, sir.
Good evening. Go straight to the point.
Please, where you mark that order block like that, there's an inducement candle down. Can we use the inducement candle?
Which one? The one that I just
That
explained.
yes. That the US 30. There's an induction candle there.
Which one?
Yes. Below the order block.
Below the other block. This one.
Yeah. That yes.
This is
That,
this is a protected low because it just take out liquidity. It take out this liquidity, so it's a protected low. You cannot call it indecision candle. It's part of the what order block. If you change the time frame, maybe you go to 1 hour, you see that it's part of the order block. Can you see?
Okay. Yes. Sir.
Can you see?
Yes. I've seen it.
Okay, you have to go, guys, and check different price action and check this one. Go and check the current